Welcome to the 129th season of the Canadian Club Toronto, Canada's podium. For over a century, this stage has united visionaries and leaders from politics, business, community, and the arts to share insights on the most pressing issues of our time. And with Canada in a pivotal moment, it's more important than ever that we come together.
We've been having important discussions and debates around this podium in this country for well over a century. I call this a historic podium of record.
Our club's always been a forum for visionaries, public figures, and decision makers to command attention to the issues of our time.
Canadian Club is one of the most important podiums anywhere in the world that a Canadian can speak to, tell Canadians what it is that they think, develop those thoughts. And so I want to thank you for that very, very much.
Please join me in thanking our esteemed panelists today.
Through our programs and events, including our youth and young leaders programs, our diversity partnerships, our joint events, and our media and social media opportunities, we offer you access to dynamic political, social, and business figures from abroad and right here at home.
The platform from which the eloquence of Canada has flowed all of that time, whether it be business, education, politics, sports, arts and culture. If someone wants to say something to Canadians about this country and about the future of this country, this is the venue you choose.
Good afternoon, everyone. Welcome back, and a warm welcome to those joining us online. My name is Shazanne Chu, President, Canadian Club Toronto, and your host. Today's discussion comes at a significant moment for private equity as investors adapt to a more selective, disciplined, and strategically complex phase of the macro investment cycle. We're honored to host this annual industry panel at Canada's podium, and our ability to convene conversations like this is made possible through the support of our partners and sponsors. Today's presenting sponsor is PwC, and our event sponsor is Torys LLP. Thank you for your leadership and support. To our season sponsors, Canadian Bankers Association and Carpenters Regional Council, thank you for your valued partnership. To our official airline sponsor, Air Canada, and Canada's Forest Trust, our nature partner, who help us plant a smart forest and who help us, reduce our carbon footprint by planting a smart forest in our honor. We thank you too. Today we're pleased to welcome students from Toronto Metropolitan University's The Dais, as well as a combined table from the University of Toronto's Rotman School of Management and York University's Schulich School of Business. Welcome, we're glad to have you with us. Where are our students? Back there, thank you. Let me take a moment to remind you of our website and its on-demand content and event information. Please visit canadianclub.org, and while you're there, please consider becoming a member if you aren't already. And we also appreciate when you post about these events on your social media network of choice. It helps us spread the conversation beyond this room. And now I'm sure you'll all have questions about capital deployment, liquidity strategies, and what today's environment signals for investors in the broader economy. So please use the question cards on your table. And for those joining remotely, please use the Submit a Question button on the right side of your screen. Our team will be looking out for those, and we'll share them with today's moderator. And now, I am pleased to invite Michael Shea, National Private Equity and Pensions Leader at PwC Canada, to formally introduce our panelists. Michael, over to you.
Good afternoon, everyone. On behalf of PwC Canada, it's great to be back with the Canadian Club of Toronto this year for our 4th annual Private Equity Outlook. So if we think back over the past few years, a lot of the conversation at this forum has been about areas such as navigating macroeconomic uncertainty, geopolitics, and a slowdown across the M&A life cycle. Those themes are still with us. But what we're seeing now feels a bit more structural. Longer hold periods, slower exits, and continued pressure on distributions and fundraising. Against that backdrop, Today's panel will explore how investors are adapting, from rethinking liquidity and capital strategies to doubling down on value creation and navigating a more selective fundraising environment. With that, I'm pleased to announce today's panel. Afsana Labelle, Managing Director and Head of Funds at CPP Investments, where she leads private equity fund investments across North America and Europe. Peter Giacomelli, Managing Director at Warburg Pincus, focused on capital formation and strategic investor relationships in the Canadian market. Andrew Walton, President and Managing Partner at Ironbridge Equity Partners, a leading Canadian mid-market private equity firm focused on partnering with founder-led businesses. Thomas Choi, Managing Director and Head of Altix Capital, focused on secondary investments in single asset continuation vehicles. In guiding today's conversation, Katie Zorbas, Managing Partner in Brookfield's Private Equity Group, where she is responsible for capital raising, co-investment syndication, and investor relations for Brookfield's private equity funds. Ladies and gentlemen, please join me in welcoming our panel.
Okay, good afternoon, everyone, and thank you for being here. After more than a decade defined by abundant capital, low rates, and multiple expansion, really doing a lot of the heavy lifting in the industry, private equity is clearly entering a new era. Liquidity is tighter, financing is becoming more disciplined, and value creation is once again front and center. In many ways, it feels like a return to fundamentals. And that shift is creating both pressure and opportunity across the industry. So with that as kind of the background context, I'd like to start with the topic really that's on everyone's minds right now, and that's liquidity. And how do we get cash back to investors? The industry has seen slower exits, longer hold periods, and creativity around distributing cash back to investors. Thomas, I'm going to start with you at Altex. Given Altex's vantage point and the secondaries position that you play, are secondaries still primarily a liquidity tool, or are they increasingly becoming a core portfolio construction and value creation strategy?
Yeah. Well, first of all, thank you, Canada Club, for having us here. Appreciate the opportunity to speak. In terms of secondary investing, yes, it's a core, but it's still in its infancy. If you put into perspective the private markets, today the private market has a NAV of anywhere between $14 to $17 trillion. Last year, secondaries represented just over $220 billion of that private market space, so less than 2% of the whole market. So while, yes, LPs are using this as a tool, as well as GPs, to sell into the secondary market, it's still a very small portion of the overall private markets. It is a tool where GPs are finding a venue to sell or hold on to their prized assets. That's what we're focused on at Altex. And LPs have always used this as a tool to kind of reorganize or structure their portfolios or restructure their portfolios so that they can continue investing in the asset class. So definitely a tool that is being used by both LPs as well as GPs now. When you see more on the macroeconomic side of things, you're seeing, people are saying, some critics on the GP-led side at least are kind of saying maybe it's because of the slow M&A market, the slow IPO market, and hence there's this new robust GP-led space. But if you look back in 2025 last year, the M&A market has actually hit a record post-COVID, and at the same time, the GP-led market has also hit a record in terms of volume. So we see that continue to grow, and LPs and GPs using this as a tool for liquidity.
And Afsana, maybe I'll switch gears to you. As one of the world's largest PE allocators today at CPP, how are you guys thinking about these various liquidity tools? Are they becoming core to how you think about your pacing and kind of liquidity management within your program?
Yes, thank you, and thanks for having me. We definitely consider it a core part of our portfolio management toolkit at this point. We have a very active and institutionalized secondaries business within our private equity department. And through that, we're able to essentially kind of control our own destiny a little bit more versus potentially just kind of waiting and holding onto some of the more tail end kind of fund holdings at this point. So I think both on the sell and on the buy, like we're actively looking at working with our GPs as well and helping them structure potential continuation vehicles and GP-led solutions. So it's a core part of our toolkit, and it's, I think, here to stay.
Perfect. And Peter, maybe from the GP side, on the manager side, how has this changed how Warburg thinks about exit planning, your exit playbook? And is there anything that you're maybe doing differently today than you would have been doing a few years ago?
Yeah, thank you, Katie, and thank you for having me here today. Yeah, I would say Warburg Pincus, we're a bit unique within the private equity world in that we're investing out of a $17 billion global fund with a high degree of diversification. So we have approximately 65 investments per fund. Many other funds that size would have closer to 15 in investments per fund. So what that allows us to do, it gives us the flexibility to pivot to where the opportunities are and what's presenting itself in the market. So for example, last year after Liberation Day, when tariffs hit and exits in industrials become more challenged, but the market remained open for software and healthcare, we're able to lean into that and drive liquidity on that side. And we're also quite thoughtful about portfolio construction and the size of investments we're investing in. We're really a scaled global middle market manager. So typically the companies we're investing in are about $1 billion in enterprise value when we invest in, and those season over time to about $3 billion. At that size range, there are a lot of private equity firms that could participate in the next stage of the life cycle for that asset, as well as being a nice tuck under for strategic. So we're not looking at transformational M&A with strategic purchasers. So you look at how that's shaken out for us. We've been in a fortunate position where we've delivered over $50 billion in distributions back to our LPs since 2020 versus deploying $30 billion. So the diversification and thoughtful portfolio construction on the front end has been quite helpful.
That's great. And so maybe just against that backdrop, I want to switch gears a little bit to fundraising. Fundraising also has obviously become more selective. There's still a lot of capital out there available, but it's clearly concentrating with certain managers. And the bar for managers feels meaningfully higher today than it did a few years ago. Andrew, I'm going to start with you. You are heading into your next fundraise, I believe, mostly targeting institutional capital. And so where are you seeing LPs on that spectrum today? Where are you feeling the bar has moved most? And what's the feedback you're hearing on the fundraising side?
Thanks, Katie, and thanks to Cannon Club, my co-panelists, for this afternoon's chat. So fundraising is obviously tough. That's part of why this panel has been put together. And the bar is significantly higher than it was. So if we rewind, our Fund 3 and Fund 4, we enjoyed start to finish closes, one and done in 12 weeks each. So that's the context of where we're coming from. That world has completely changed, and we're well aware of that. We are fundraising likely the end of this year for Fund 5 or early next year. It's dependent on some exits that we do or capital deployment into new platforms. But maybe a measurement of how it's feeling out there is a colleague and I were in Europe last week, priming the pump per se to talk to new investors primarily. About 20% of our money comes from the UK and Europe. And the resounding message on the positive is Canada is seen as an attractive place to access the North American market. So they look at the US and Canada similarly, And that North American allocation is still there, and Canada is well placed relative to what's going on around us for that money to find its way here. But there are absolutely headwinds. The liquidity issue is primarily from, I think there were 43 meetings in 1 week, and that message coming back was fund of funds and institutionals are really struggling because the flywheel of money coming back has actually stopped. So it sounds theoretical, but when you're sitting in a meeting, they say, literally, we don't have money this year. Can you come back next year? It's not the same message in the family office side of things. Family office side appears to have significant capital to deploy, which is great. So we've got our work cut out for us because it all comes down to where you stack. Are you top decile? Are you top quartile? If you're not in those two, you've got massive headwinds. And challenges in your portfolio company, it's not going to be a case of, well, you've got a really good track record, and the message to our pool of investors in Europe plays very well. Ironbridge has been around for 20 years. We've gone to our fifth fund, stable returns, stable team. These are all very powerful. But where do you stack relative to what's available to them? And they have a lot of available options to them. Not only do they have to take care of their re-ups, but investing in a new GP in Canada, that's a fairly large stretch. So we'll see how the tail end of this year plays out or early next, but we're ready.
That's great. And Thomas, I'm going to get your viewpoint on the same question. Obviously, Andrew spoke about the institutional side of things. I know at Altex you also have some more kind of families and high net worths in your fund. So maybe just that perspective contrast to the institutional side.
Yes. So for context, Altex LPs are predominantly high net worth and family office investors. When you look at our investor base, I would say you have a few sophisticated high net worth family office investors who have an understanding of the private equity market, like capital calls, distributions, and timing. And then there's another group of folks, because our fund is in USD and we have a lot of Canadian investors, they have to pivot and kind of say, oh, I gotta convert my CAD to US, and it takes time to actually get those capital calls through. So you have a mix of both sophisticated and non-sophisticated folks. The similarity, I would say, with institutional investors is that a lot of these family offices, high net worth, they want to see return of capital before we're committing to the next fund. They're saying, we want to see DPI, we want to see your strategy, especially for a fund one like us, realizations and your strategy actually coming through. And so we're seeing a lot of folks saying, yes, we're interested in Fund 2, but we want to see some DPI from Fund 1. And so you have that similarity. There are growing number of folks on the high net worth side that are more attracted now to the more, I guess, semi-liquid or evergreen funds as opposed to closed-end funds. Again, you're seeing a lot of shift from less sophisticated high net worth moving to open-ended versus closed-ended funds. So we're seeing that shift right now.
Perfect. And we're going to come back to the evergreen side of things a little bit later. But Afsan, I want to get your viewpoint. What is differentiating managers for you? Are you consolidating down your GP roster? And what do you think about when you think about those you want to continue to work with go forward and maybe even re-up at scale versus those who you maybe will cycle out of your program?
Yep, happy to share some thoughts on this. We have a large, mature portfolio of buyout GPs. And actually, we went through a period of consolidation that kind of predates the current market environment, which is interesting. And we're coming from a place of actually looking to grow back to the number of GPs that we think is the right number for our specific program. And that's built through a combination of looking for returns and then GPs that also can partner with us in our many different ways that we do that at CPP Investments. So interestingly, despite the maturity of our program, we're back in kind of re-ramp, and then I think we'll hit a steady state. In terms of what differentiates managers, particularly in this environment, we spend a ton of time on how they navigated the recent market downturn. And so not too dissimilar from kind of the GFC period where we were looking at really kind of troubled funds at that point in time. Today is a little bit similar in that respect with 2021 vintages. And so digging into that vintage period and understanding what true kind of lessons learned have been applied internally, what processes have actually changed, and are we seeing early proof points of that within the subsequent fund to try to gain conviction.
Perfect. And all of that points to a market that is increasingly more selective in terms of the capital side of things. And really conviction in your managers needs to be earned. And so it naturally raises the bar just not on the fundraising side of things, but also in terms of how managers are actually creating value and how the industry is creating value go forward. And so, Andrew, I want to come to you. I think we're a bit similar, actually, in our approaches in terms of Brookfield and Iron Bridge, in that we spend a lot of time at Brookfield focused on operational value creation, especially in industrial businesses. And so I want to know just how that resonates with your approach at Iron Bridge, and where are you finding the most impactful levers in terms of creating value today?
So to set the stage, probably worthwhile telling you what we actually do, which is we don't buy pristine businesses. That's not for us. We're not buying 12 times multiple, upward to the right, growing in 25% type businesses. We're buying companies in the traditional sectors of manufacturing, distribution, and services. And within that, we are trying to take a business that's opaque, hard to understand, got some issues. Some would say we're in the hair removal industry. And we are trying to take that company from buying it in this ecosystem and domain and then getting it ready for prime time, where we take it to a much bigger pool of buyers that has an appetite to pay more, the story hangs together, and the management team is ready, and they're on a growth path. And that's our role in the ecosystem. So at its core, value creation is in our DNA. All of the managing partners at the firm have actually sat in the chair, been the CEO or CFO or some form of operational executive in companies. So our lens may be a smidge sharper than most on what we think we can do with a company. But history will say that I've never seen an owner-entrepreneur build a company and not optimize the time when they're selling it. So we are takers with respect to how businesses end up on the market, and you better be ready to know what you're going to do. What is your plan? That is the first question our investment committee asks is, what are you going to do with this business? Because by definition, you're buying it at a suboptimal time because it's been primed for exit, and sellers are wily foxes. So you've got to make sure you're ready. There are three things we look at, which is, one, in its simplest form, our value creation plan can be broken down into three pillars. And it's management muscle is the first thing. 90% of our deals are owner-operator successions, so we are trying to solve a management issue and add muscle. So that's the first thing we do. And the second thing is ensuring that the management team is speaking one language. So the confusion of how a company actually makes money, we try and iron that out during our ownership period so everybody is singing from the same hymn book. And the last thing is putting them on a growth trajectory. What story are we telling to the next buyer? So it's organic and acquisitions. And throughout that, you've got to execute. And we only have this treadmill stop for moments, which is when you're actually selling a business. The rest of the time, the IRR treadmill is just humming away quietly in the background 24/7. And we have to prove to our investors that we can generate returns. So we have to have a plan that we can execute and be decisive, and it needs to be precise, and it needs to adapt to this world that we're constantly living in, a barrage of change. And we've got a lot to learn. Been around for 20 years, still got a hell of a lot to learn of how to actually execute this, but it's part of our DNA.
That's perfect. And Peter, maybe just to move on to AI. We can't have a panel and not talk about AI and how it's impacting the industry. Andrew mentioned a lot of kind of the traditional operational side of value creation. How is Warburg thinking about AI? Do you think it'll be a true differentiator go forward, or will it just be a tool that kind of everyone in the industry is eventually using?
Yeah, no, thanks, Katie. I think AI is a defining strategy and valuation within private equity. We're in the early stages of transformational technological change. I think it's important for all of us in the room to embrace AI, if we haven't already, and given the pace of change, to stay on top of that as it evolves, because it's moving quickly. For us at Warburg Pincus, we've been focused on this for some time. So by way of background, 3 years ago at our CEO Tech Conference, we had Dario Amodei in to present just as Claude 1.0 was being launched. So it's something that we've tried to be thoughtful about for some time and be on our front foot. What we're doing with our portfolio, we have a fairly large portfolio at over 200 companies. So a couple things we're doing there. We've stack ranked all 200 of those portfolio companies with respect to AI. From the companies that we expect to be beneficiaries and have tailwinds right on through to those that could be most challenged. And with that, we've also implemented one of 5 archetypes for those portfolio companies. So those could include software development, R&D, retooling, go-to-market strategy, business automation. So very, very defined playbooks. We think it's critical that we partner with the CEOs at the portfolio companies in order to get buy-in. We think this is a CEO-led initiative at the portfolio company, not only chief technology officer initiative. And for us on our value creation team, we invest heavily in value creation. We have 75 professionals globally in value creation. We've been adding very seasoned professionals that are focused and dedicated on AI to support our deal teams and those management teams. So I think in summary, I think that the private equity firms that get AI right are going to be very well positioned to create durable returns and outperform the broader market. It's a top priority for us.
Excellent. I think we would definitely feel the same at Brookfield. And Thomas, I want to move to you back to the kind of secondaries landscape, particularly thinking about GP-leds and continuation vehicles where you guys spend a lot of time. You're often underwriting assets kind of mid-hold in their life cycle, right, rather than at entry. How do you think about value creation in that context? And where do you see the most opportunity to really drive incremental upside within those investments?
Yeah, so the benefit for GP-leds and continuation vehicles is when we're investing midlife, the private equity firm, the GP, has already shown success, typically, with the asset or assets that they're involved with. And so it's our role really to kind of say, how much more growth is there, and is it worth the risk? What we like to see is downside protection. So unlike Andrew, we want to see winners. We want to see continued growth in these companies as opposed to turnarounds or resets, where occasionally GPs will try to take an asset, reset the value creation, and go forward plan. On the other hand, for Altex, we'd like to see that value creation plan succeeding and continue to succeed. Yes, is there a lever that there's a new strategy that may come into play during our hold? Yes, but that wouldn't be the core of the growth. It would be just the continued success of their original investment thesis and maybe a lever for another strategy that may kind of offset or give that exponential growth. So what we're trying to do in the GP-led space is minimize downside risk. So the GP has familiarity with the asset or assets and know where they want to take it in the next 3 to 5 years. And B, maybe our returns may not be a 5x or more. We're looking at a band of returns of anywhere between 2 to 3x is our target.
More consistent.
So very consistent, lower, I guess the lower band in terms of returns, but very downside protected.
Great. I'm going to move on to geopolitics. We're going to switch gears a little bit here. Geopolitics is increasingly, obviously, moving from kind of just a macro backdrop to something that's directly impacting investment decisions, although it does require everyone to kind of break through the noise of what's actually going on in the market today. Peter, just from the GP perspective, are you actively underwriting different scenarios around trade, tariffs, or regional fragmentation? How are you thinking about what's going on in the market today, and does it affect kind of opportunities that you may choose to pursue or ultimately avoid?
Yeah, definitely. The current geopolitical environment is about as complicated as it gets, and the macro and geopolitics are more tied into the micro than at any point, really, in most of our careers, I'd say. So it's showing up in a few different ways. For us at Warburg Pincus, back to our geographic footprint, I would say first lever we look at is a geographic pivot. And if I look back over the last 15 years and our exposure to China, at one point in time, we would have had meaningful exposure to the Chinese market. What we observed over time was the macro and geopolitical environment deteriorating, yet valuations weren't commensurately declining to keep pace with that environment. So we've pulled back from China. It represents around 1% of our current fund exposure, so a de minimis amount, but doesn't mean pulling back from Asia. So we're active throughout Asia. We've been in India for 30 years, and we've really leaned into that market because we felt that macro and geopolitical environment was actually opening up some interesting opportunities on the private equity side for us. Second area would be sector rotation. We talked about that earlier, following Liberation Day. When one door closes, another door opens. So we're taking advantage of the flexibility to invest across sectors without any defined target, sector by sector, really looking for the most attractive risk-adjusted returns. And finally, I'd say on a more granular level, when you think of down to approving investments, within our financial models, for all companies that have cross-border exposure, we're factoring in tariffs, and that's the vast majority of our portfolio. When it comes to taking investments to underwriting committee, we're also looking at scenarios that include a modest recession, and it's very important for new deals that they earn their private equity cost of capital, even in that modest recession scenario. So I would say the diversification is helping us navigate this extremely complex environment, but the bar is higher to get deals done, no question.
Right, and Andrew, maybe let's bring it a little closer to home in Canada. How are these same dynamics playing out at the portfolio company level in the Canadian mid-market space? And what are management teams doing differently as a result?
So when I think about the last 5 years, we've all just been through the barrage of when you pause and think about it and go, that's been a tough session for us. COVID walks into interest rates, transforms into inflation, disruption in the supply chain, and now we're dealing with tariffs. And we'd love to have a little bit of wind at our backs at some point. It'll make life a little easier, being able to sell some assets, because this has obviously atrophied the M&A market over the last 5 years, where things are just really difficult to get out of assets because the entire market is, from our vantage point, has stalled to only super high-end assets that are AAA grade being sold. And that's not where we focus. We don't focus on AAA assets. So as context, I think for our fund at the moment, tariff overhang and all of the second-order consequences that the threat of tariffs has on our businesses is very significant. 12 out of 17 of our businesses export to the US, anywhere between 10 and 80%. And that's obviously a lot of headwind in trying to make a decision, given that backdrop of what we've been through in the last 5 years, trying to execute that plan, that value creation plan, where there's just not enough breeze behind you to actually make it happen. Because the consumer, both in Canada and the US, and as I mentioned, we own 17 companies, we think we have a reasonable vantage point of how the consumer is feeling. The consumer is weak. And it shows up in non-discretionary spending over a 5-year period ending up in discretionary spending bucket. And that's a real challenge for a private equity fund that invests in non-discretionary spending type assets, because people just defer. And you can just defer and don't do your maintenance or whatever it is on a particular product. So for us, we're not changing our playbook. We're continuing to execute that plan, do acquisitions, even when the support structure is not around us to give us that confidence. And the decisions are taking longer and they're harder to do, but you've got to realize that at some point, blue skies are going to show up. They will show up. You You just got to be ready when they show up so that we have taken that asset, got it ready for prime time, and we can hit that window. That's the overarching challenge we're trying to get through right now.
Right. And so I'm going to throw my fellow panelists a little bit of a curveball here, because we do have questions. So there's papers on everyone's table if anyone's interested in submitting. And so a question came up: how will the new sovereign wealth fund that the Prime Minister announced, I think on Monday, and the Toronto Investment Summit impact the Canadian landscape?
That sounds like a Peter question. I'd be able to give you a little bit more context when we have more context of what the fund is going to be doing, what its objectives are, how it doesn't overlap with pre-existing asset classes in that particular area, and who's going to be running it. What is the team? Once we know that, we can have a conversation about how we feel about it. But it's obviously a good thing that there's attention on building infrastructure in Canada and making projects happen.
Yeah, and more broadly, details to follow on this particular initiative.
Yes.
But I'd say it follows the theme, the level of engagement from all levels of government, from the Maple Lake Canadian pension funds. I think it's a very exciting time for Canada, and it'll be interesting to see how this plays out. And we can look at some of our past successes. If I look at some of the transactions that Canada Infrastructure Bank has done and some of the deals we did together with Brookfield and your portfolio company, Enwave, that's now owned by Ontario Teachers and their partner, there's some great initiatives, and we can help get things done that otherwise wouldn't have the opportunity to get done and drive value for Canadians.
Excellent. So I've got two topics left that we want to cover. We have about 10 minutes left. The first is I want to touch briefly on evergreens. There's a big trend in the market today. Essentially, the private wealth channel has opened up to private equity, private credit, and so we're seeing a lot more of these come to market now. We ourselves at Brookfield just launched an evergreen strategy late last year with the goal of really, accessing that wealth channel, but importantly, making sure that we don't compromise on strategy. And while it's a huge avenue for growth, there's obviously clear complexities around alignment, deployment, and ultimately liquidity. And so, Peter, I just want to come to you first. I don't think you guys have launched an evergreen quite yet. Not sure if you're thinking about it, but where have you seen firms maybe get this wrong, and what differentiates the platforms that are doing this successfully?
Yeah, no, happy to take that question. And we actually just launched our evergreen fund in February.
Well, there you go.
So, Maud, so we can speak from real life and recent experience, and I think it's an enormous market potential.
Yeah.
I believe, and we at the firm believe, it's filling an important need for individual investors to get access to the private equity market, where you think of the $250 trillion of assets held by individual investors globally, having less than 5% exposure to private markets versus sophisticated institutions being north of 20%. This is really something that I think retail could benefit from longer term, and we factored that in with the launch of our product. I think there's really two things that we're focused on. The first is alignment with the model. So the way we've structured our fund is that our retail vehicle, WPACE, invests alongside our flagship private equity fund in the exact same investments and portfolio that our most sophisticated LPs are investing in. So I think that alignment is critical, and I think we're set up as a private partnership, one global carry pool. It all creates alignment to keep it simple and make sure that those investors are getting access to those opportunities that the leading global LPs are getting access to. And I think the other side, liquidity management, has to be, we have to be honest about that. As we've seen in the market over many years now, semi-liquid does not mean liquid. Stress can mean gate suspensions, forced asset sales at unfavorable prices. So I think for us as the GP and the advisors who are working with their clients, I think it's really critical that the investors who are allocating capital to the semi-liquid vehicle really understands what liquidity means. But I think if you get that right for the private equity firms that have the alignment, the honest liquidity terms, fair economics, I think that's going to result in long-term success in that market.
Excellent. And then, Afsana, from your point of view, obviously our industry has been built and many of our funds have been built through the institutional channel. And so where you sit today, maybe what are some of the complexities or even concerns that you would have sitting on the institutional side of the fence?
I mean, I think it would be hard to even come up with a scenario where this trend could be positive for institutional LPs. So I'll just start by saying that. I think it's also a material one. It's a big shift in how this industry is being capitalized. And frankly, it's coming at a time where the industry is already well capitalized. So it's at an interesting kind of point where we're kind of adding to the dry powder in a new way. We obviously understand the GPs' kind of motivations, aspirations to diversify their sources of capital. But I think it's something we're spending a lot of time talking to our most strategic partners about. And I would just say, in terms of complexities and things we're focused on, there's near-term issues and then longer-term issues. I'd kind of bucket them like that. I think near-term, we're getting under the hood of these vehicles, understanding how they're structured, how they're going to be allocated, what kind of disclosures we're going to see in kind of the LPAC materials around participation of those vehicles alongside of our funds. In some situations, we're also, when we're in kind of re-up negotiations, actually looking to ask for LPA terms that would protect the level of participation of retail alongside and the amount of capital that can be raised. And then I think from an alignment standpoint, there's also kind of differing economics. So understanding, the GP's impacted alignment with us by having differing economics and terms on something alongside. So those are the near term. And then what I would say longer term, and something at CBP we've been pretty open about. I mean, we invest in a partnership-based model, and to the extent that the spirit of partnership evolves in a different way, we will reassess. And I think at the end of the day, we're looking to build, so at this point we have many partnerships and relationships that span 2 decades, and the ones that will persist for the next 2 decades will be ones where we're still an important anchor part of that capital base.
Right. So I think the discipline is really important on the manager side to that point. We have about 4 minutes left, so I'm going to actually just skip ahead. I have one kind of final question I want to throw out to the panelists, and I would ask you to try to keep your answers very brief. My question is going to be very broad. What's one risk or theme that you think the market may be underappreciating now, and where are you most optimistic? Andrew, I'll start with you.
Perfect. Productivity. So very briefly, 45 years, you go back to 1980. Canada's investment in capital equipment across the spectrum is down about 40%. The US is double. And what does that mean? Real GDP per capita, get to 2015, the lines are almost mirror images of each other, and they diverge dramatically in 2015. Maybe related directly or indirectly to capital investment, but as an investor in the average, which is traditional industry businesses, knowing instinctively that we as a country have underinvested in our businesses makes that business I'm looking at non-competitive relative to global standards, and that eats away at us.
Excellent. Afsana?
In terms of underappreciated risk, maybe quickly on that one, I do continue to think that there is unlikely to be any kind of miracle kind of catalytic event that will unlock this exit pipeline that we're facing in private equity. So I think it's going to be a really long, slow, somewhat painful drag, unfortunately. And then on the optimistic side, I have to put AI out there. I mean, part of my team is also growth equity, and we just see a lot of promise in that business. And I was just over in Menlo Park last week, and just the pace of innovation. And I think if private equity as an industry can embrace it, and there is proof that PE can do that in other changes, I think this could be a real boom for the industry.
Great. Peter?
Great. Yeah. In terms of underestimated risks, I'd say structural repricing of the commodity complex and unintended consequences in terms of how that ripples through portfolios, whether it's margin compression, valuation, multiple compression, would be something to watch. On the optimistic side, I might take two to be optimistic about. I think the current vintage of deal flows, the capital that does get deployed, I think time will tell. This will be a good time to be putting capital to work. And particularly excited about single asset continuation vehicles. I think there's a real supply-demand imbalance. And when you think of single asset continuation vehicles, it's really the counterpoint to a lot of the headwinds that we're facing. So that logjam of assets being held for longer, challenging exit environment, waiting for bluer skies, as Andrew said, for GPs, especially mid-market, lower mid-market GPs. This is a transformational opportunity for them, and the personal wealth creation creates a significant amount of alignment. So actually, quite enthusiastic about that part of the market. Second thing, I would say Canada. We have so many inherent advantages as Canadians that we really collectively haven't taken advantage of over the last decade or more. And it's great to see a call to action from levels of government and industry leaders. So very excited about what the future has for all of us here in Canada.
Excellent. And Thomas?
Peter and I used to work together, so I was going to say the same thing. Listen, I think oil, commodity, is going to be a big risk. I don't think people are paying enough attention to that, the trickle-down effects of the portfolio, like you said, Peter. Everyone's focused on AI data centers, but the energy crisis that we will be facing, I think that's going to be a big impact in near and long-term future. So that, I think, is not being focused on enough. And then, again, opportunity, I think, like Peter was saying. Secondaries continues to grow, and we're just lucky to be in the space, and so we're excited about that.
Excellent. Thank you. Well, look, I'm very proud of us because we actually just finished right on time at 1:30. So on behalf of all of us up here, just want to thank you for having us this afternoon, and we will turn it back over.
Thank you. On behalf of Canadian Club Toronto, Thomas, Peter, Afsane, Andrew, thank you so much for your expertise and your depth of perspective. Katie, thank you so much for your deft moderation of this very wide and complex topic, or many topics. I would also like to extend our sincere thanks again to today's sponsors, PwC and Tories, for making this event possible, and a special thank you to our production partner, VVC Live, for your outstanding support. Canadian Club Toronto, we remain committed to being a premier platform for dialogue that informs, connects, and inspires action across our country. We have a few upcoming events this spring. It's a very busy spring. On May 1st, we host breakfast with Premier Doug Ford and Minister Vic Fideli. On May 11th, we welcome Mark Mackey, CEO of Trans Mountain Corporation, and Elizabeth Wademan, CEO of Canada Development Investment Corporation. And on June 1st, we welcome Justine Hendricks, President and CEO of Farm Credit Canada, and Alison Sundstrom, Managing Partner at Naya Ventures, to discuss Canada's generational opportunity in the future of food and agriculture. To learn more, please visit canadianclub.org. Members and guests, thank you so much for joining us today. We invite you to continue the conversation, and we'll see you again soon. Thanks.